how the journey went was like, okay, if this guy is like, if he's right in what he's saying, then this must be measurable, right? So he talks obviously about time and price theory, and so that's what I started to dissect, right? What I started to learn was that when we start talking about like, and I don't know how familiar you are with like with arrays and stuff in price. Like, well, when you say order block, when you say fair value gap, they're ICT concepts.
Yes. Yeah.
In fact, what people do not understand is like ICT coined the term smart money concepts years ago when he was teaching. This guy's been teaching for like 20 odd years or whatever it is, right? So what happened when that was only like a fraction of the information, and people took that, like repackaged it, made courses, and then didn't want to give the credit to ICT, so called it smart money concepts. The smart money concepts is like the preliminary version to like ICT, which ends up going to like PhD level technical analysis. I mean, it's nuts when you get to like the higher level of it, right? But to keep it very simple so people can follow with it is you have like data points, right? So what is an algorithm essentially is inputs and outputs, right? So you have one input and that will lead to an output, right? And in fact, what I realized, it was actually in the middle of COVID while I was doing prescriptions and stuff, I realized that when somebody's asking me a question, there's a series of inputs, aren't they? Right? They're asking me questions, right? And based on the questions that they're asking me, there's going to be a response. There's going to be an output, right? So I started to look at the market in the same way. If and then, right? So if this is happening, then this is going to be the outcome, right? So that was just getting my head around that first, and then thinking, okay. So he talks about these two things, these variables called time and price, right? Now, when we look at like previous data, we're looking at specifically when it comes to price, we're looking at the open, high, low, and close, right? Now, they're specific levels, right? They're measurable, they're levels in price, right? Now, them levels in price don't mean anything if they haven't got that variable of time, right? Them levels have to align with time in order for an instruction, which is a macro, to tell price to either spool to one of two things, really, what it's going to be, right? It's going to be either run above buy side or sell side liquidity, right? Or it's going to rebalance inefficiencies in price, whether buy side or sell side, right? Now, that concept was, I mean, that to get my head around what was difficult in the first place, but what I had to understand first was like the market efficiency paradigm, and again, trying to keep it basic, but it makes sense once you think about it, where like, say we have above old highs, what we're going to have like buy stops, right? And below old lows, we're going to have sell stops, right? Now we're taught in the books to place our stops above old highs and below old lows, right? So the interbank level guys already know where our stops are going to be, right? And the algorithm job is to manipulate price to create these peaks and troughs. And the algorithm itself doesn't know where your stops are individually, right? It's manipulating price because it knows that, okay, there's going to be a pool of liquidity here, and there's going to be a pool of liquidity here, right? So what I started to see is there's this, essentially the market runs on buy and sell programs, right? And there's this system called the accumulation, manipulation, and distribution, right? AMD, right? The AMD. So I think smart money understands like the way, right? So say like you got like a consolidation range, right? Below that, you're going to have, say, sell stops. Okay. So the algorithm is going to reprice below them sell stops, and they're active, or they become active orders in the markets, right? So they're willing sellers to buy at that price. The algorithm is going to reprice lower, and then interbank level traders, because it's not the algorithm making money, right? The interbank level traders are above banks. So you got Barclays and UBS and whatnot. These are sitting above that. These are between the central bank and the other banks, or people think of banks, right? The banks don't trade like this. It's interbank level and higher, right? So the algorithm's filtered from it's developed by the actual central banks themselves. So what happens is like interbank level traders will recognize these footprints in price, right? So I'm assuming they understand how the algorithms work, right? So when the algorithm reprices below sell side liquidity, it will pair like long positions with that liquidity. The algorithm will then reverse, and then those interbank traders will offset their longs with active buy orders above the market, so in the form of buy stops, right? So then buy stops are literally like they're waving a huge flag saying like, we're willing buyers up here, and we're willing to buy at a higher price. And if you think about it, like there's no hard sell here. You know exactly who's buying and who wants to be sellers, right? Which is how I now actually trade. When I look at price action, I'm looking at who's been making money. if the sellers have been making money, right, they're gonna get attacked at one point, right? So that for me was huge. I can't stress how important that is understanding who's been making money in the markets first in order to know where the liquidity is going to be, right? So that's essentially what the whole market is liquidity to liquidity, right?
Yeah.
So when I understood, that was like my building blocks of like, okay, this makes sense, right? Because like if they understand how the markets move, they're going to know where the buy stops are going to be, where the sell stops are going to be. And if I was making the market, of course, the best way to do it is buy from the sellers and sell to the buyers at a higher price, right? So then the concept of understanding like a raise in price and time, that made much more sense. So what I'm saying is, if we look at old data and we look at open, high, low, and close, right, and these are specific price levels.
So when you say open, high, and low,
so
you're talking about the candle.
I'm talking about the candle.
Yeah.
There are levels.
Yeah.
There are levels in between that as well. So there's midpoints, but that's another conversation. But if we just focus on the open, high, low, and close, right? Now look at the open, high, and low. And close. Don't look at it as a candlestick. Look at it as a price level. So these are specific levels, right? Now, if an algorithm needs data points to refer to, it's going to refer to these data points in price. Don't look at them as price levels. Look at them as data points for the algorithm to, when it's indexing its arrays in price, it's going to refer back to these data points back in time. They've already been printed, so they're there. We can see them, right? But how do we use that information to predict future price action, where price is likely to go, right? Now, if we know that, okay, the high time frame is like, say we're bullish, right? And I can see a level on the weekly time frame. Essentially, this is how I trade. I'm looking at what that weekly expansion is going to be, right? If that weekly expansion is going to be higher, I'm looking for the algorithm to reprice lower, right? And it's going to do it in two ways. It's either going to run sell stops, or it's going to reprice to, say, a sell side imbalance somewhere, right? Sorry, buy side imbalance somewhere, right? Below the market, right? Now, again, I'm trying to keep it simple without losing people. Like a sell side imbalance, there's two things that the algorithm is going to do. It's going to reprice to areas of liquidity, or it has to, because it works on parameters of fair value, right? Now, again, trying to keep it simple, but if the market is offering buy side, so there's one side of the market that's being delivered, right? Because of the way the algorithms are created, it has to work on these principles of fair value. Therefore, it has to rebalance and reprice back through that range. So if buy side has been offered, sell side therefore has to be offered, right? So when all of these like different concepts, like when you blend them all together, it starts making much more sense, right? Because, and I'm probably not doing the best job in the world.
No,
I apologize, Michael, for like doing this. He's obviously the guy to go to learn.
Well, like
you
said, there's no chart.
Without a chart, it's difficult to obviously explain.
But yeah.
What I was going to say is like these price levels, if you haven't got time that comes into play, then these price levels don't mean anything, right? Okay. And this is what I'm trying to get at, like a long-winded way of doing it. I am Michael's student, so it makes sense. But if we have like these, if we got say like sell side liquidity, right? The sell side liquidity will reprice, the algorithm will reprice, take out sell side liquidity, and it will go into a higher time frame data point, right? Yes. So look at these levels as data point. When that data point aligns with time, then an instruction is sent for the algorithm to either reprice or rebalance, right? That's really the two things that it can do. But you have to have that timing window to align, which is why I say when I've got like a 2-hour timing window, essentially I'm looking at a higher time frame data point, which the algorithm is going to remember in its memory. And once that key level, that key data point is hit, right? That's an input for the algorithm. When that aligns with time, an instruction is going to be carried out. But the instruction cannot be carried out if the data point doesn't align with time, right? So that makes sense that there's an input now for an output to happen. And the output is only going to be, like I said, repricing above old highs and old lows. I mean, the algorithm is very limited in what it can do. It can either consolidate, it can expand, it can retrace, or it can reverse, right? And when you understand that the whole thing works on buy and sell programs, you can start to work out, especially when time aligns, where you are within this buy and sell program. So it starts getting really, really intricate, and you can get very, very precise with it. But it goes deeper than that as well, because I was like, okay, if you have like a buy program, then how does the algorithm know how high and how, like if it's a sell program, how low to go? There has to be something in the algorithm that's going to cap the highs and the lows, right? So, well, that's what we ended up finding is like, there's certain data points within price, within market structure itself, that there's mathematical deviations that will be calculated, right? From
You're
these.
doing well, Mr. Do you know Kit?
No.
ICT concepts?
Oh, right. Yeah. Sorry. Yeah. Of course I do. Yeah.
Savage guy. I did a podcast with him in New York, and that's what he was like, 3 standard deviations. I'm like, yo, you lost me. I'm gone.
That's just the tip of the iceberg. This thing's got, I've done this for 5 years. Like, if I could really delve into it, the problem is I'm going to lose absolutely everybody if I get into this.
Just explain the deviation.
So, like, if you're looking at, like, within pricing structure, there's going to be, like data points in price. And again, like I said, these algorithms are going to refer to these data points, right? And when you've got, again, time that aligns with these data points, it's going to create, like, these, how to explain it? So, deviations is, like, say, like, you've got 0.1 and 0.2,
Yes.
right? And what it's going to say, that's like a range of, say, like 100 pips,
Okay.
right? It's going to, and we don't know, like, how it really does it. We don't really need to know, like, how it does it. What we need to know is that when these deviations align with time, right? So say the algorithm will say, right, okay, this data point, there's 100 pips through this range, right?
Okay.
We want to, like, do 3 standard deviations of this. So the high will be 300 points from that range. Right?
Okay.
Do you understand? So, like, you'll have your deviations.
Three,
in price.
okay.
Yeah.
So
right.
the deviation is it the range?
Is the range
And then
itself.
3 standard deviations would be
With
3
three of that range.
Okay.
So those data points are measurable in price. This is what I'm saying. So, like, when I started to see that, actually, that makes sense because now these data
Is this
points.
where people would use a Fibonacci tool?
This where they use Fibonacci tool, yeah, but not the way Fibonacci, obviously Fibonacci numbers. That's exactly. So when you're seeing all these charts and stuff, that's what the deviations in price are.
So
now,
the ICT version of using the tool.
Yeah, exactly. So when you now say, like, have a time window that now becomes open, let's call it, say, the New York session, right? And you've got these deviations in price that you've already seen in previous price, so you can work out how high or how low it may go, and say, like, we're like in, like, looking for the weekly expansion on a higher time frame, right? Now we're looking, and again, this is time of day and day of week specific. Say it comes down to maybe a Tuesday or a Wednesday, we've got some high impact news on the economic calendar, and we're now expecting, sell side liquidity. I'm looking at that pool of liquidity, right? They're going to get eaten, right? And it's going to come down into this higher time frame data point, which is an array, and then it should spool to the buy side liquidity and fulfill that weekly expansion, for example, right? So when you what was I talking about now?
The deviations.
Oh yeah, sorry, deviations.
You on the day of week and week.
So that when that time window aligns and we say we've got these deviations in price, we can also then look at these higher time frame data points as well. When these deviations align with the data points and align with time, we can pinpoint the exact high and the exact low. And it's not me just who can do it. This is now tons and tons and tons of people who can do it. Thousands of people across the world who can do it. So this is a point that I want to make here, right? Because learning this has obviously been a very long, hard process for me, right? I'm more convinced that there's an algorithm in the markets than some of the medication I was prescribing. So you put that into perspective, right?
Definitely.
So what I'm saying is that, like, it's not easy and it takes a long time, and a lot of people are going to write it off quickly because they're going to look at Michael and say, look, he's arrogant, he's egotistical, which he can be. To be fair, he probably has a right to be if he has a hand in creating these algorithms. Whether that's true or not, we don't know. But I will say this, right? I am very, very, very well versed after 5 years of doing this, like, relentlessly to understand how these algorithms now book. I'm probably trying to write a paper on it or something at some point, the amount of information and notes that I've got on it, right? But, like, this is how good he is like, I can now get to a point where I'm like, okay, I know when to stay out the markets. And this is the best thing about ICT concepts, is that you can determine, like, your high probability versus your low probability setups, right? And I think that everybody should understand and learn ICT just basically for that. You can apply any strategy that you want to it. It doesn't matter. But if you understand the basic, like, how the algorithms move and basic price action, you'll be able to, like, I think personally, make any strategy better. Any sort of, like, any model that you've got, any school of thought that you've got in it. So because ICT students look at, like, this is the truth of the markets, and they've done their own research, they've backtested, and they've come to eventually the same conclusion that I have, right? They get this arrogance about them, and they, like, ICT is the only way to trade, right? No, it's not. Like, I'm telling you straight, no, it's not. Like, ICT probably takes up about 40% of it. The 60% still comes from risk management and psychology. You could flip a coin and have good risk management and psychology and still make money, right? So it's not really, again, making money with ICT concepts is not, again, a good indication of, like, whether these concepts work or not. You have to separate the money element and separate Michael, right? Because people, like, a lot of the people, my students who come into my mentorship with me, they're like, what would take probably Michael an hour to do, I'd like condense it in 2 hours, in 20 minutes. I mean, it
You
probably
doubled it up, wasn't
no, I know, yeah. And to be honest, it probably would do with the way I am. But like, obviously, they don't see the outtakes of it. It takes me a long time to like edit all these out. But why I do that though is because of the struggling points that I had, because it's so much content, right? And trying to just make it simplified. And the reason for this is because like, I think now after my journey and understanding and finally getting to the other side and finally being able to turn this around and become profitable after such a long time, I find it, I don't like the fact that people are put off Michael because of the way he is, and write his concepts off that, you know, he's a fraud. And that's totally false. Okay, separate Michael and separate the money and everything. Just look at, is there an algorithm? And if you really study it, you'll find that there has to be an algorithm. There has to be.